Alright, so welcome back everybody to another lesson in our swing trading course. And I am excited to announce that we are officially through all of the beginner stuff and we can start getting into some more juicy bits. This next module of lessons, we are going to be talking about managing your money and managing your psychology, which are two of the most important things that you could ever learn when you're trading. But before we get into that, please remember to click the subscribe button, like this video, share it to all your friends, and click the alert button. We're going to be launching a lot of free educational content in the future to help you with your trading, and you are not going to want to miss out. Also, don't forget to leave your comments and questions in the sections below. I do try to answer all of them. Capital management. In this first part of the second section of our course, we're going to be talking about position sizing specifically. This is literally one of the most important lessons that I will ever teach on this channel. With good capital management, you will never succeed at trading. As a trader, the money you are investing into the market, your capital, is your most important tool. Without it, there is no way at all you can make money because you can't trade. You could be the best technical analyst in the world. You can find all of the best setups and know all of the exact entry times and exit times to make all kinds of money, but if you don't have capital, you cannot take any of those setups. Protecting your capital is your top priority when you trade. It comes before everything else. So how do we do that? Because we are exposing ourselves to risk every single day. Every time we enter a trade, we expose ourselves to risk. Position sizing. Position sizing is a very important part of trading. There has been some research shown that randomly buying and selling in the market based off of just, let's say, a random number generator. If it goes to 1, you buy. If it goes to 2, you sell. If your risk management techniques and position sizing are correct, you still make money. Position sizing will allow you to define your risk per trade and your risk to your total account value. This also allows you to determine your estimated return on capital over a number of trades. So, feel like this is kind of important yet? How do we go about figuring this out? I'm about to tell you. First, you would need to know your total account liquidation value, or your net liquidation. I'm going to be using a $5,000 account as an example. If you have $2,500 in cash and $2,500 in open positions, our net liquidation is $5,000. Your net liquidation is your total account if you sold everything, the value that would bring. So if I have $1,000 in cash and $4,000 in open positions, our net liquidation is still going to be $5,000. Now, we need to determine how much risk we want to take on each trade. This is how much money you lose if you're in a trade and you get stopped out. Trust me, you're going to have some losses, sometimes even strings of losses. This number should stay consistent for every trade that you take. You can't change how much you risk based on how you feel. This is going to bring you into trading emotionally, and we don't want to do that. We want to trade based on probabilities, not emotions. This number should be between 1 and 3% of your total liquidation. I suggest starting with a 1% trade, then moving up to a 2% risk as you get more comfortable in your trading, but never ever risk more than 3% of your account. Your numbers over time will compound, and 1% per trade today might be $10. 1% a year from now may be a couple of hundred, maybe even $1,000. This number compounds as you go. So the size equation is your percent total risk multiplied by your total capital. divided by your risk per share. That could be a little confusing. Let's get into it and I'll show you how to do it. So first thing, let's use our $5,000 account for example. We need to determine our risk. We're going to use 1% as an example. So 1% of $5,000 is $50. So we want to risk $50 per trade. Let's say we want to trade ABC stock and our entry price is $10 per share. We have set a stop loss at $9. So our risk per share is going to be the distance between our entry price and our stop loss. In this case, that's $1. So we have a $1 risk per share. So now we want to take our total risk per trade and divide that by our risk per share. So $50 risk total divided by $1 risk per share equals 50. So in this case, we would buy 50 shares of ABC because if our stop loss was hit, we would lose a total of $50 or 1% of our total account. So we're going to jump into a quick little deal about profit targets here. In the prior example, we determined that we had a $1 risk per trade. So we always want to take profit targets at 2 times our risk per trade. So our entry price here would be $10 with a $9 stop loss and a target price of $12. That would equate to $500 total capital being used. A stop price would lose us $50 total if it were hit 1%, and we would lose or win $100 total, or 2%. So we're risking 1% to make 2%. We always aim to get 2 times our risk when we take a trade as profits. This way, if we're right only 40% of the time, yeah, I said 40%, we're still going to make money. So let's keep using our $500,000 account to explain. Imagine we took 10 total trades. We had a bad month and we lost 6 trades out of 10. That's 40%. We have a 40% win rate. So using this system of capital management, guess what happens? We still make money. Why? Because 6 losses at $50 equals a $300 net loss. 4 wins at $100 equals a $400 net gain. So with a 40% win rate, we can expect to make $100 on those 10 trades. Good news is that you don't have to do all this math in your head. I'm going to show you a free tool that will do it for you. But all I'm asking is that you click the like button and the subscribe button in the channel in return for showing you this tool. So let me pull it up here. This is a position size calculator, and I will put it in the box below. So let's just go back, and so what you do, your total account value here, in our case $5,000. How much percentage do we want to risk? In our case 1%. Our entry price was 10. Our protective stop was at $9, and then all we have to do is click compute. We would take a 50 share size position. This position would cost us $500. We risk $1 per share, and our total percent of that position risked would be a 10% stop. And we risk $50 total of our account. Now let's say we took that trade and we lost. So we would lose $50. So now the next time we take a trade, let's clear all this stuff out. We would only have $4,950. Right? Oh, sorry. $4,950. So that's going to change our stuff a little bit here. So now let's say our next stock let's say ABC's back on the rise. It's up to $14.40, and that's where we want to jump in at. And then let's say our stop loss for this one would be $12, just for posterity's sake. This is just random numbers. And our risk per share would be $2.40. So when we put our profit targets in, let me get a pen here. So our risk per share here would be $2.40. So our 2 times that, which would be our target, would be $4.80 on top of our entry price. which would be, so we take our 2 times risk, add it to our entry price, and that would be our profit target. But we would purchase 20.6 shares. I would probably round this number up to 21, or you can round it down. It doesn't really matter. That would take a total position size of $296 of your capital. And anyway, I figure that pretty well about covers it. So please remember to like, subscribe, and comment, and we will see you in the next video.